In this video, I would like to consider the disadvantages of balanced funds. While balanced funds offer several advantages, they also come with some disadvantages that investors should consider. And so here are the key pitfalls, the drawbacks of balanced funds. Number one here is limited upside potential. Limited upside potential. Because balanced funds invest in both stocks as well as bonds, their potential for high return is often lower than that of an equity-only fund. So if stocks perform well, the bond portion of the portfolio, may limit the overall growth of the entire fund, making it less ideal for investors who are looking for higher growth. Because essentially, this kind of portfolio is made up from the stock portion as well as on the bond portion. And if the equity market does well, the stock portion will then grow, and the bond portion may not actually grow in unison. So it kind of limits the potential growth of the overall of the entire fund. Number two is less flexibility in asset allocation. Less flexibility in asset allocation. In the typical balanced fund, the asset allocation is predetermined and is generally remained within a fixed range. For instance, you may have 60% stocks and 40% bonds. So this limits the flexibility for investors who may want to adjust their allocations based on changing market conditions or personal investment goals. So the ratio is already fixed. You have 60% stocks and 40% bonds. So it's difficult to somewhat adjust, and this might not really go well with investors who want to have that flexibility on how they want the fund to be managed. Number three is diluted risk-reward ratio. Diluted risk-reward ratio. So while balanced funds, they tend to balance risk through diversification. They may also dilute the reward for more aggressive investors. For example, a person looking for high growth may find the mix of stocks and bonds less optimal, compared to an all equity fund, especially in a bull market. In a bull market, equity funds do perform very well because of the fact that there's this particular bond aspect of the balance fund. It tends to limit the expected growth of a typical balance fund. The bond aspect tends to drag down the expected or desired growth of this fund. Number four is management fees. Management fees. So they are actually managed. Actively managed balance funds may come with a higher management fees compared to the typical passive index funds, like your exchange traded funds. And so these fees can eat into the overall returns of the investor, particularly in a low growth environment, making it a kind of less cost effective for some investors. The fees they're charging will invariably eventually eat into the overall ultimate performance or returns of the fund at the end of the day. And number five is it's not ideal for short-term investors. It's not ideal for short-term investors. If you have a short-term mindset, then of course the balance fund is not for you. So balance fund actually, are generally most suited for long-term investors. In the short term, the combination of stocks and bonds may not provide the level of returns needed to meet specific financial goals, especially in a rising equity market, or a low interest rate environment. And so if the equity market is rising, as I told us earlier, the bond portion of the fund will tend to drag, will not rise in unison, because usually stock and bonds don't, they tend to, their movement don't correlate. They don't correlate at all. Number 6 is bond allocation may underperform. The bond allocation may underperform. And so in a rising interest rate environment, bond prices tend to fall. The higher the interest rate, the lower, bond prices, the lower bond yields. So which can negatively impact the bond portion of the balance fund. This may cause the fund to underperform compared to funds that have, a higher allocation to stocks during, a bull market. Number 7 is a potential for over diversification. Potential for over diversification, and you discover that balanced funds, are often invest in a wide variety of stocks and as well as bonds, which can lead to a kind of over diversification. This means that the fund may include too many assets, some of which might not significantly contribute to the overall returns of the fund, and by so doing, limiting the potential growth the fund could achieve. Please like this video and subscribe to this channel. Number 8 is limited customization. Limited customization. And so investors who prefer to handpick individual stocks and bonds may find balance funds too generalized for their own needs, because they can't really customize the portfolio to meet their personal investment goals or aims. For instance, an investor nearing retirement may prefer a more conservative fund, while the typical balance funds may still have a significant stock exposure, which may not really go well with someone close to retirement or a retiree. And you discover that this may lead to a higher risk than desirable, a higher risk than what is expected, than what the investor could stomach or could bear. Number 10 is underperformance during bull markets. Generally in the bull markets, the stock market rises, and the stock prices are generally are making an upward movement. So during strong bull markets, the bond allocation, in the balance fund may limit the potential to outperform pure equity funds, which can achieve higher returns in such an environment. Pure equity fund will perform wonderfully well in a bull market compared to the balance fund, because on the balance fund has a bond portion that doesn't really perform as well, that may not perform as well as the equity part of it. You discover that investors looking to maximize returns during market booms might be disappointed with the performance of a balanced fund. These disadvantages suggest that balanced funds may not be the best choice for every investor, particularly those seeking a higher returns or who prefer to actively manage their portfolio themselves. So it's important to evaluate whether the risk and the return profile of the balance fund aligns with your personal investment goals, as well as your risk tolerance.